Pause everything. This is deadly serious. Clear your desk. Block out distractions. For the next few minutes, I need your full attention. The market intelligence I'm about to reveal is the dividing line between market noise followers and alpha hunters. This isn't just a signal for wealth redistribution, it's a structural shift so profound that most investors, lacking macro perspective, will be left utterly confused. Listen carefully, investors. The foundation of the tech sector is cracking. Today, I'm not here to pitch a hot stock. I'm talking about a decade-long capital migration that's unfolding in real time while retail investors remain oblivious. If you're still staring at NVIDIA's chart, praying it retests its all-time high, you're not just missing beta returns. You're watching liquidity slip through your fingers. Just now, Meta, the flagship under Mark Zuckerberg's command, dropped a strategic nuclear bomb in the AI arena. They've officially confirmed shifting billions in capital expenditure toward Google's TPU architecture, instead of continuing to rely entirely on NVIDIA. Let's interpret this from an institutional lens. This is the highest level form of supplier substitution. It's like a wartime commander redirecting core military orders to a rival. This isn't routine spending, it's a seismic signal that confidence in NVIDIA's core customer base is crumbling. Understand the implication. This isn't just a purchase order. It's a declaration of war against the existing hardware hegemony. NVIDIA, the so-called king of AI hardware, once seen as having an impenetrable moat, its fortress has just been breached from within by its largest enterprise client. I can already hear the market's rebuttal. But NVIDIA has a monopoly. It's unbeatable. Friends in Wall Street, this is the most expensive cognitive bias. This time is different. It's the same linear thinking that buried Blockbuster, Nokia, and BlackBerry. Today, we're witnessing the first structural crack in the armor of a modern tech titan. The question is, will you misread it as a buy-the-dip opportunity or recognize it as an exit alarm? In this briefing, I won't just provide code, I'll present due diligence evidence, hard data, and a logical chain. We'll deconstruct macro liquidity, industrial economics, and the flow of smart money to argue why Google is emerging as the new AI champion through vertical integration and how you can position yourself in this historic capital rotation. This isn't about a single stock. It's about understanding the dominant trend for the next 5 years. Get ready. All right, everyone. Before analyzing individual stocks, we must first confirm the macro climate. You wouldn't set sail without checking the weather. Investing is no different, and the monetary policy environment has just undergone a 180-degree reversal. For the past 24 months, why did NVIDIA command a premium? Beyond Jensen Huang's execution, the core driver was high interest rates. When the Fed tightens, capital becomes expensive and risk-averse. It won't fund long-term stories, it chases predictable cash flows. Who delivers that? NVIDIA, the pick-and-shovel provider. Hardware sales offer immediate returns, so capital flooded in. This was essentially a defensive allocation. But notice this, the wind has shifted violently. In mid-November, even the Fed's most hawkish governor, Christopher Waller, signaled a clear pivot. Swaps markets now price in 81% probability of a December rate cut. 81%! This isn't speculation, it's market consensus. What does this mean? The liquidity floodgates are reopening. As capital costs fall, money becomes aggressive and expansionary. It no longer settles for one-time hardware profits. It seeks platforms that can build closed-loop ecosystems, generate network effects, and tell exponential growth stories. Think of it this way. For the past 2 years, we've been in risk-off mode, and everyone crowded into the sturdiest bunker, NVIDIA's. But now, the storm is fading. Risk appetite is returning. Capital is stepping out of the bunker. It's not looking for shelter anymore. It's looking for fertile ground to build new infrastructure. That ground? The AI application layer. And Google is the developer with the blueprint and the heavy machinery. This is the perfect macro backdrop for Google's valuation reset. Google isn't just hardware. It's search, YouTube, cloud infrastructure. It's a full-stack solution. It's like shifting from investing in a brick manufacturer to investing in a skyscraper owner who collects rent for decades. On top of that, progress in US-China high-level talks has removed a major geopolitical risk premium for large-cap tech stocks. The rules of the game have changed. The market logic has shifted from defensive to offensive. Institutional money is beginning massive portfolio rebalancing, moving from pure hardware makers to platform giants. This migration is just getting started. The macro wins are set. Now, let's dive into the tech battle, Google versus NVIDIA. There's a massive misconception in the market. People think most powerful compute equals best business. That's engineering thinking, not capital thinking. In the enterprise market, victory depends on two variables, efficiency and TCO, total cost of ownership. That's it. NVIDIA's H100 is a performance beast. It's like a Swiss Army knife, great for graphics, training, inference, but for that versatility, it sacrifices efficiency, making it extremely expensive and power-hungry. Google's TPU? That's a laser scalpel. It's an ASIC, application-specific integrated circuit, built from the ground up for one task, machine learning. It strips out all redundancy. It's a pure efficiency machine. The hard data is undeniable. In AI inference workloads, Google's 4th-gen TPU delivers 30% lower latency than the H100. Deploying TPUs on Google Cloud cuts operational costs by up to 25%. 25% per year. This isn't just savings, it's freed up R&D budget. That money could fund thousands of top AI engineers. It's a structural competitive advantage. Imagine your competitor starts the race with a 25% cost edge. You either evolve or die. For giants like Meta or OpenAI, burning billions annually on compute, a 25% cost reduction isn't optional. It's fiduciary duty. It means billions flowing straight to the bottom line. That's the driver behind Zuckerberg's decision. This isn't about partnerships. It's cold, hard balance sheet logic. But the real moat-level battle is in the ecosystem. NVIDIA's model is hardware plus CUDA. Powerful, but dependent. It relies on downstream customers to build hit applications. If they can't monetize, or worse, decide to vertically integrate and build their own chips, NVIDIA's moat dries up. Google is different. It runs a software-defined hardware loop. Google controls the endpoints, search, YouTube, Android, reaching billions of users. It embeds Gemini models into these touch points. Real-world usage data feeds directly into the next-gen TPU design. This is the ultimate feedback loop. Every search click, every video play silently optimizes Google's chip design. It's a self-reinforcing flywheel that NVIDIA can't physically replicate. NVIDIA sells shovels to gold miners. Google is the biggest gold miner and uses its own experience to build better shovels for the market. Whose iteration speed do you think is faster? This closed-loop, self-sustaining ecosystem is what NVIDIA craves but can't access because it lacks consumer endpoints. Result? We're witnessing a business model leapfrog. NVIDIA faces pressure from customer internalization. Channel checks even hint at inventory buildup. H100 inventory days are rising. That's a red flag. Meanwhile, Google is executing a three-pillar strategy. 1. Supply TPUs to Meta, capture hardware revenue. R. Rent TPU, compute via Google Cloud, collect infrastructure rent. 3. Boost ad conversion with better AI, grow core business. In Q3 2025, Google's AI-related revenue surpassed $20 billion, with gross margins holding at a staggering 68%. It's a money-printing machine. It proves Google has built an end-to-end, high-margin AI commercialization engine. The first half of the AI race was an arms race. NVIDIA won. The second half is about precision strike capability. And Google, with its ecosystem, is locking onto the target. The logic is closed. But don't just listen to the narrative. Let's track the money flow. This is the most critical piece. Follow the institution's footprints. If you only read headlines, you'll see retail investors shouting, "Buy the dip on NVIDIA." But dig into 13F filings and fund flow data, and you'll see a different picture. Throughout November, we observed clear fund divergence. Google saw consistent net inflows, while NVIDIA experienced net outflows. Sovereign funds, pension funds, the big players are rotating positions. This is the calm before the storm. Retail noise dominates social media, but in the investment committees of top global hedge funds, the agenda has shifted. They're asking, where's the next growth engine? Where's alpha after hardware saturation? Algorithmic traders are quietly executing orders, shifting billions from old cycle winners to new cycle challengers. Capital has no loyalty, it chases ROI. And the wind is blowing toward Google. One more key point. This is the most elegant hedge in this trade. Let's talk about Broadcom. When Google's TPU news first leaked, Broadcom stock wobbled. I saw the comments, "Isn't Broadcom Google's foundry partner? Why is it down?" I called it then, and I'll say it again. That was knee-jerk market noise from weak hands. The market misread the fundamentals. The correction came. On November 25, Broadcom stock surged 11%. 500 Shiyi. Why? Because smart money corrected the pricing. They realized, wait, Broadcom is the core IP and manufacturing partner for Google's TPUs. If Google's TPUs scale, Broadcom wins. JP Morgan's research predicts Google's TPU project will generate over $10 billion in revenue for Broadcom in 2025. This is what I call the toll booth model on the AI highway. You don't need to bet on which car wins, you just charge every car that passes. That's the beauty of paradigm shifts. The biggest fortunes aren't made by the new king, but by the arms dealer who supplies the new king. In the gold rush, the guy selling jeans made more money than most miners. Broadcom is supplying the mining equipment to Google, the giant who just struck gold. This is institutional level play. Instead of fighting in crowded, overvalued trades, capital is flowing to the next phase beneficiaries, Google, and its core supply chain like Broadcom. You've seen the macro reversal, the industrial logic, and the money flow. So how do you act? How do you position in this historic rotation? Listen carefully. Risk management is non-negotiable. No position, no voice. Do your due diligence, trust data, but verify. This isn't financial advice. It's my trading strategy. First, the rule. No leveraged Allen bets. No gambling. This is structural allocation, not a lottery. Conservative strategy. Focus on Broadcom. It offers exposure to Google's TPU logic with more defensive P valuation. Current E is around 22x, offering a margin of safety. My play? Wait for a pullback to $345 near the 5-day moving average for staggered entry. Hard stop loss at $330. Ideal for alpha-seeking but risk-averse investors. Aggressive strategy, Google plus Meta combo play. You go long both the supplier, Google, and the major adopter, Meta. For Google, look for entry near $300, a key support level. For Meta, watch the $600 psychological level. Use trailing stops. Let profits run, but never let a winning trade turn into a loss. Passive allocative strategy. If you're not a stock picker, the best path is adding to tech ETFs overweight in Google and Broadcom, or look at underpriced laggards old in the ecosystem, like Amazon. Set up a dollar cost averaging plan. Ignore short-term noise. Time in the market beats timing the market. The key is a trading plan. The worst move is watching Google hit $318 and chasing it out of FOMO, fear of missing out. That's how retail investors lose. Stay patient, stay disciplined. The best entry points go to those who wait for confirmation. The trend is your friend, but only if you don't jump on when it's exhausted. The next 12-24 months of alpha clearly lie in the Google ecosystem and the AI application store layer. If NVIDIA can't break into the application bottleneck, its valuation reset will be painful. Finally, we must address the biggest opponent in trading. It's not the market, it's your psychological biases. Humans tend to extrapolate recent trends into the infinite future. NVIDIA was a huge winner, so the brain assumes it will always win. This is called recency bias in behavioral finance. It leads retail investors to be greedy at the top and fearful at the bottom. I'm asking you to do something counterintuitive. Exit the narrative that made you money and enter the new one that's just starting. It'll feel like cognitive dissonance. While your peers talk about NVIDIA's earnings, you're positioning in Google's ecosystem. They might think you're crazy. That's fine. The biggest capital returns in history belong to those who go against the crowd before the trend becomes consensus. One final thought for you. Business evolution is ruthless. It doesn't care about past glory. 20 years ago, Nokia was the undisputed king of mobile. Its hardware was unbreakable U. But Apple arrived with touchscreens and the app ecosystem. Nokia didn't fail because its phones were bad. It lost a paradigm war. It was outmaneuvered by a higher-order business model. Nokia's Minsky moment wasn't the day the iPhone launched. It was when developers began migrating en masse to iOS, when the ecosystem's network value surpassed the hardware itself. Today, we're at the same inflection point in AI. The question is, are you holding Nokia or Apple? Today, NVIDIA is a great hardware company, but if it remains just a hardware supplier, unable to build an application moat, it will face existential pressure from full-stack giants like Google. This isn't alarmism, it's the inevitable law of technological evolution. As an investor, the biggest mistake is fighting the last war. We cling to yesterday's king. My goal today is to remove your blinders and show you where the next wave is forming. The AI revolution isn't over, but the captain is changing. The question is, which ship's ticket do you hold? After reading this briefing, we'll stay with NVIDIA or begin rotating into the Google ecosystem. What's your highest conviction tech stock for 2026? Leave your thoughts in the comments. I'll review everyone. If you agree with this logic, prove it with action. As always, stay sharp, manage risk, and I'll see you next time.